Good evening. It's 6:05. So welcome to Business 2505D, Winter 2013 term. So today is Tuesday, January 8th, and I'm going to review chapter. Well, first I'm going to talk a little bit about the course, like information, outline, that kind of stuff, and then I'm going to review chapter 2 from 2504 tonight. So, you know the title, my name's Mitch Murphy. For office hours, I don't set up specific office hours because most of the time people don't show up, but I'm available by appointment, either before the class or after the class, or, by the way, I'm not a prof here. I actually have a job out. I own a business in Quebec, but I also have an office at headquarters of my company in Ottawa. So that's another place that you can come meet me, and it's actually a lot easier because there's parking and there's plenty of meeting rooms. If you have a car, it's actually more convenient for you to come meet me at my office, which is on the corner of Brookfield and Riverside, just across the street from Mooney's Bay. But I can meet you also on campus. My office is in Dunton Tower on the 10th floor. And like I said, you gotta just get an appointment because I don't like just coming here an hour early and staring at the wall. It's a waste of time. So my email, my Carleton email, everything has to go through this. That email, and also when you send an email, please send it from your Carleton email if you can, because there's some rules that the university says. For example, if you're asking about grades, I can't answer to like a Gmail or Hotmail or something like that. The website is lemma.ca/2505D, and there's one thing I forgot to put on that slide. Some of you have taken courses with me before. You'll know that I'm actually recording the course while I do it, and then after that I get the TA to edit it and I put it on YouTube. So the videos are posted. So if you're a bit of a keener, you can I just finished teaching this course in the fall. So you can just look at the YouTube videos for every chapter. If you're leaving town, you want to get ahead or something like that. The textbook is the same textbook as 2504. And people ask, is it okay to use the 6th edition? And I say, yes, it is. There's no, it really doesn't matter which one. There's not a big difference between the two. In terms of the text in the chapter is the same. I've never actually found any difference. The only difference from 6th to 7th edition is that there's a few new problems at the end of the chapter, and then all of the problems they just change the numbers. So it's the same text, but they just change the numbers in the question, and then they add a couple here and there. But in general, this 6th or 7th is you can use either. It doesn't matter, and you can get 6th edition for like dirt cheap. In terms of the grading, we're going to have 4 in-class quizzes, so that's in here at the beginning of the class on those 4 dates there, January, February, and 2 in March. So that's 15%. It's best 3 out of 4, so I take the best 3, and then each one of them is worth 5%. There's going to be 2 group assignments. Each one is worth 7.5%. You can do it groups of 4 people max, but anywhere between 1 and 4. I actually suggest 2 is the best. I'm just a big fan of the group of 2. The problem when you're just one person, you don't have somebody else to kind of bounce ideas of or like to externalize what's going on inside your own head. So it's nice to not work alone, but to work with another person. Once you get to a group size of 3, I'm sure most of you have experienced that. There's always somebody that's just dragging their feet. And then 4, it's even worse. So you'll find, it works great for cops. I worked in the computer business for a long time. It works great when you work with pairs of two. There's something that works really well when you have a group of two. But you're free to, if you want to do it alone, that's fine with me. But you can do it up to a group of 4 people maximum. So you'll have to please send me an email, Mitch_Murphy@carleton.ca, letting me know what your groups are going to be. So that's 15%, 7.5 each. The first one is due mid-February, and the second one is due the last week of class. The midterm is going to be in class. It's worth 25%. It's the first week after spring break. And then the final exams worth 45%. And then it's going to be anywhere between April 13 and 27th. So, make sure you don't book a flight back home on the 26th, because that's not a valid excuse for missing an exam that you got a flight somewhere or something like that. So, any questions about the grading? A little bit of, my bio. What have I done? How did I get here? I got a bachelor's in mathematics and computer science. I did an MBA and then a PhD. I did all of it here. So for a long time, I worked in doing websites. So I worked at Disney, Mercedes-Benz, BBC. Then after that, I decided, well, I had some DJ friends that wanted to start an online record store, and so I got sucked into it. But that was the music business is about the worst business you can find in the world. It didn't last very long, and I ended up selling it to a label owner in the UK. After that, while I was a student, I had a friend from Environment Canada that saw some of my the papers that I wrote, and he was really impressed with the way that I did, graphics and all that kind of stuff. So I ended up working in environmental statistics, mostly specializing in greenhouse gases. And so I was one of the biggest experts in Canada on the Kyoto Protocol. Obviously, there's not much work for a Kyoto guy anymore, so I found something else to do. When the Conservative won the majority election last year, right away I knew I had to find something else to do. And so I ended up joining Sunbelt, which is a business brokerage. So think of investment banking, mergers and acquisitions, but for small and medium companies. And so we split our market into 2 groups. What we call small, or the Americans call it main market, which is the companies worth 0 to 3 million. And then what we call medium or middle market, 3 to 50 million. Anything above that tends to be handled by more, the smaller investment banks in Toronto, and then after that, bigger investment banks. But we're basically another way of looking at it is we're like real estate agents. Instead of dealing with houses, we deal with companies, small companies. So, garages, restaurants, hotels, that kind of stuff, retail. So that's it about how I got here. So this is not new material that I'm doing tonight, and I'm guessing we might be done a little bit early. In this course, 2505 is a continuation of 2504, but all I'm going to do today is review Chapter 2 and maybe cover it in some parts a little bit more in depth than you saw in 2504, just because a lot of the notions from Chapter 2 are used in some of the other chapters that I'm going to cover in this course. So mostly it's about cash flow. You're going to hear that expression in this course at least 100 times. And taxes too. Another difference between 2504 and 2505 is a lot of times when you consider taxes a problem, it makes the calculation a lot more complicated. So in 2504, well, it's an intro course, and it's everybody has to take it in business, as opposed to this course, it's only people that specialize in accounting and finance. So I'll warn you, this course is about 10% more difficult than 2504 is. So if you look at, say, an average would be say, 80 in 2504, and then you would get a 70 in this course. So if you want to get the same grade in this course than you had in 2504, you need to step up the effort quite a bit. So what I was saying about taxes is, in 2504, to make things simple, we just ignore taxes, and so it simplifies things quite a bit. Yeah.
So is it 25 not added on to what we learned in 2504? We learned a lot more new concepts.
New concepts. There's some chapters where we redo that. Like, here's an example. Chapter 14. We only do about 2/3 of chapter 14 in 2504, and we skip the end of the chapter. That's pretty difficult. In this course, we kind of backfill the more difficult parts, and then we do some chapters which are a little bit certainly more difficult than 2504. Chapters like 16 and 21 are definitely a lot harder than 2504 was. So in 2505, we do consider taxes. In 2504, we made it simple by ignoring them, and it makes the calculations pretty simple. In this course, anytime that we do a problem, we're looking at how does tax affect the analysis. And then the last one, capital cost allowance, that's the version, that's Canada Revenue Agency's version of depreciation. So I'll show you how that works. So cash flow is it says is one, but I would say is the most important piece of information that a financial manager can derive from financial statements. You can find, there's three statements in financials, right? There's the balance sheet, the income statement, and the statement of cash flow. The problem with the accounting profs, what they do is they teach you the first two, and they barely show you how the third one works. But it turns out that the third one is really the only one that matters in the end, because if you think of why do you own a business, you own a business to make money, right? If you have a business that says, it's got a accounting profit of $1 million, but there's no cash that's getting generated, well, that's not really a business. You can't live off of that. The other thing is, there's been a lot of scandals, and if you look hard enough, you can always find a crooked accountant that can pull some shenanigans on the balance sheet. You can find a crooked accountant that can pull some shenanigans on the income statement. But the cash flow statement is almost impossible to fake. Because if you look at, as an auditor, you want to audit the cash flow of a company, you call the company's bank at the beginning of the year, how much cash in the account? You call the company's bank at the end of the year, how much cash in the account? It's easy to verify. You can't, unless you have, the bank manager, is also part of the fraud. Like, it's very hard to fake the statement of cash flow. There's so many different, shenanigan tricks that you can pull in the balance sheet and the income statement. Again, with the statement of cash flow, you call up the shareholders. Did you receive your dividends? Yes or no? You call up the bondholders. Did you receive your interest payments? Yes or no? And they're going to tell you yes or no. It's not going to be, well, based on GAAP, rule number 1234 versus IFRS and this and that. Like, there's no interpretation that cash is there or is not there. And it's the most important measure of the health of a company. Because a company can survive for a long time if it's not making an accounting profit, but it can't survive if it's running out of cash. Right? If a company runs out of cash, doesn't matter how many sales they have. They just can't, buy the next load of inventory. They can't pay the employees, and they're dead. So cash is to a company is like blood inside a human body. Once it runs out, the company dies right away. So we're going to look at basically how cash moves in and out of a company in different ways. This is a chapter 1 picture, but I'm just using it to just, after the holidays, kind of get you back into the groove of things, and just to give you an idea of how a company operates. So first, a company gets cash from somewhere. So it says firm issues securities, but that's that could be, you start your own company and you put like $1,000 in the business account and you go buy yourself a lawnmower. Well, then in that case, you raise your capital from the owner of the business. But other companies might, do an IPO, might do, go to a venture capitalist, go on Dragon's Den, get a bank loan, get a government grant, whatever. You got to get the cash from somewhere. Then you take that cash and you buy assets, you buy equipment. Then you use that equipment to generate sales and profit. And out of those profits, you can do three things. You can reinvest in the company. So going on the lawnmower example, I did pretty well in one summer with my lawnmower. I made a bunch of money. So I just take the money that I made at the end of summer, I might buy myself another lawnmower and hire an employee next summer. So that's reinvesting in the company. You have to pay back your investors. So it could be, you pay back the bank loan or you pay dividends on your shares. And of course, the government, is like the mafia, they always get their cut. Just a small concept, although it's not directly reported on a balance sheet. In terms of a balance sheet, in terms of short-term health of a company, this is one of the most important measures to look at. Even though it doesn't actually have a line, when you look at the financial statements of a company, there's not a line that says net working capital is this. But it's the difference between the current assets and the current liability. And if that ends up negative, it means that you owe more things in the next year than you have money over the next year to pay them. What happens? Somebody's going to put you into bankruptcy, or they'll, repo some of your equipment or something like that. So, net working capital, very important that when you're managing a company, you always keep an eye on this, and you'll see that when we do cash flow analysis, that's one of the things that we look at. How much net working capital do I have when I start? How much net working capital do I have at the end of my project? And how much net working capital do I need to use? So let's look at how cash moves in and out of a company. So the statement of cash flow is split into three sections: operating activities, financing activities, and investing activities. Operating activities is basically running the business, right? So it's, if you sell something for cash, as opposed to, issue an invoice, it becomes an accounts receivable and you receive the payment later. When you do a cash sale, you receive the cash right away. When you do a credit sale, on the day that you do the sale, you don't actually receive cash, but you receive cash when the customer pays their bill. So the actual cash flow doesn't happen at the sale, it happens when the invoice is paid. Similarly for suppliers, you either buy something directly for cash, or you buy something from a supplier, they give you an invoice, and typically you have 30 days to pay. So the cash doesn't go out of your account, not when you buy something, but when you pay the invoice, if you're buying on credit. And then another big part of cash flow is you got to pay your employees. And I forgot one. I made that picture years and years ago. But one of the things that I like at Sunbelt is I see many financial statements of real companies over and over again. So I get a pretty good feeling of where money goes. The other one that I definitely forgot here is rent. Like if I can give you one piece of advice about business, is never ever open a restaurant, because when you look at the financial statements of a restaurant, after the owner pays the rent, the employees, and buys the food, usually there's very little money left, if any at all. Most restaurants either break even or lose money. There's maybe 10 or 20% of restaurants that actually turn a profit. So this is running the business day to day. Now, things that don't happen very often but that support that is financing activities. So this is that first arrow at the top there. So you can get capital either from shareholders or bondholders, and the cash flows there are when you sell shares. So that a shareholder buys a share, they're going to give you cash, right? So they give you cash, and then you increase your common stock account. And then when you pay dividends, that's a cash outflow. You have the exact same situation, but with debt. When somebody buys a bond, you receive cash, and then you pay back interest and then the principal either throughout the term or at the end, depending on how the loan is structured. So this is financing activities. This is where you get the cash to, most of the time you finance to invest. So what happens here? You buy fixed assets, so cash goes out. And then maybe when you're done with the asset, not always, sometimes you use the asset all the way until the end of its life, and then you just send it to the scrapyard. But otherwise, if you sell the asset used while it still has life left on it, it's called salvage. And so when you salvage something, a little bit of cash comes back. So you'll see these two cash flows in some of the analysis we'll do in chapter 10 next week. So let's look at different parts of where cash flow comes from. Well, so operating cash flows, day-to-day activities, right? Buying from suppliers, selling to clients, and so on. Net capital spending is the money. It's basically it's the cash part of the fixed assets. So it's what I spent money on new equipment minus what cash I got from getting rid of old equipment. But there's no depreciation in there. All these things are cash flows. So depreciation is not a cash thing. It's just an invention of the imagination of accountants. It's not actually cash that comes out of your pocket. Cash comes out of your pocket when you buy the machine at the beginning, but throughout the life of the machine, you're not paying depreciation out of your pocket every month or every year. So net capital spending, there's two ways that you can get to it. You can either take, like I just said, what you bought minus what you salvage, but another way to get at it, remember that net fixed assets is whatever the fixed assets at original cost less the accumulated depreciation. So say I buy a piece of equipment for $10,000. So far I've taken say $4,000 of depreciation. So I would have accumulated depreciation $4,000 and then net $6,000. Sometimes people confuse the original cost of the fixed asset versus what the net fixed asset is. What net fixed asset means is the original cost minus the accumulated depreciation you have up to now. And by the way, it's not accumulated amortization. That's another thing that accountants get wrong all the time. And when I look at financial statements at Sunbelt, even people with CA at the end of their name still make that mistake. Does somebody here know the difference between amortization and depreciation?
Amortization is on intangibles.
Yeah, correct. And depreciation is on tangibles. There's one more bonus mark. What's the third version of that? Depletion. Depletion is when you have natural resource rights. So say there's like so many tons of gold in a deposit, or so many barrels of oil in a well, and as you pump it out, you deplete it, and so that's the third one. But you won't see that in this course, and probably unless you're working in natural resources, you'll never hear of this concept again. But those are the three ones: depreciation, amortization, and depletion. So another way to get to net capital spending is to take the difference between the net fixed assets of 1 year versus the next, but adding back depreciation because to go from the net fixed assets at the beginning of the year to the net fixed assets at the end of the year, you added the stuff that you bought, you subtracted the stuff that you sold, and you took a depreciation expense. But depreciation expense is not a cash flow. Remember that this is a cash flow. And so you just take the difference between the net fixed assets and you add back the depreciation, and that's another way to get to it. The last one is changes in net working capital. Some students have a little bit of an issue with that because what that is a difference of differences, right? Net working capital by itself is current assets minus current liability. But changes in net working capital is the difference between net working capital at the end versus net working capital at the beginning. And so it's the difference of differences. So it's current assets minus current liabilities at the end minus current assets minus current liabilities at the beginning. So sometimes students have an issue because of that kind of difference of difference. But that's what. So let's do a simple example of operating cash flow. So sales are 16,500. Now, one important thing, when I have a line like this that says less, then, okay, well in this case I have less cost of goods sold, 10,350. I don't actually say minus, because if I wrote it this way, what I'm saying is 16,000 minus a negative number. So if I wrote it this way, remember in accounting, when you got the curlies, it means negative. If I wrote it this way, then the total of this would be 26, 850. That's not what I mean. So whenever I say less something, even if it's a positive number, you're subtracting that amount. Now, I'm going to use this expression here just because it's convenient, but you've probably heard the expression CapEx, right? Capital expenditure. There's another shorthand, OPEX, which is just operating expenditures. Just easier than writing operating expense. This won't be on the final, but when you go out there and get a real job, you'll probably hear that expression. So, EBIT, earnings before interest and taxes. Here's another abbreviation I'm going to use quite a bit. TI for taxable income. The last one would be net income. And and I, but I'm not actually going to use that because what I'm looking for is operating cash flow. What do I have? Oh, I didn't put the. So operating cash flow is EBIT plus depreciation. That together, EBIT plus depreciation is what's called EBITDA, earnings before interest, taxes, depreciation, and amortization. But in the textbook, you don't really see that. I don't think I've ever seen EBITDA in there. But this is a very common measure of, because what it is, it's a measure of a company's cash flow before you account for the interest, because some companies will have more debt, less debt. Some companies will have different taxation and so on. So EBITDA or EBIT is a measure of the cash flow of the company independent on how much bonds or how much shares it has. And obviously taxes, that's an outflow, right? It's you gotta pay, like I said, you gotta pay the government. So normally, you would put net income is whatever, but I don't need that. So what I want, operating cash flow, which is EBIT plus depreciation minus taxes. So I need, the reason why I did this, it's because I need this number I need this number, and I need this number. So I'm running a little bit low on space here, but oh, and one thing I have to say is what I write on the board is what I call notes. So these are called the slides, and this is what I call notes, and those are available online at my website. And also I'm using CU Learn for I used to use WebCT, but trying out CU Learn. So I also put up, so on my website and on CU Learn before the class, I put up the slides and I put up the notes. So instead of having to just scribble the whole time, you can just download the notes, and if you missed a class, you can also get the notes. This is a slightly more complicated version of operating cash flow, and here's the reason. Instead of what we just did there is what's called top-down operating cash flow. So you start with sales, you take out your expense, you get to EBIT, you take out your interest, you get to taxable income, take off the tax, you get to net income. There's a couple more that we'll cover in chapter 10, but at least this one, if you look at that one, here's what's going on. So to get operating cash flow, you need to know the EBIT, the depreciation, and the taxes. That was easy in the top down because we just did our income statement and then we just had all those numbers we could pull out. In this case, instead of starting at the top, the question gives you data starting at the bottom. So it ends in net income is 46,750. So remember that what we need are taxes and we need, is there interest? Yeah. We need EBIT, and we just have depreciation given to us in the question. So we need to know what is EBIT and what are the taxes before we can plug into our question. That last one is what I would call the basic question. All right, you just have a formula, you put the formula, plug in the numbers, bing, bing, you're done. This is what I would call intermediate, where you got to think a little bit, and you can't. In this case, you got to run the income statement backwards, starting from the bottom net income. So if the net income is $46,750, what are the taxes? So let's look at an important concept. Net income is taxable income minus the taxes, right? That's how you get to this line. You take what is the taxable income minus the taxes gets you the net income. What are the taxes? Let's rewrite this part here. So taxes are T, the tax rate, times what your taxable income is. So I can rewrite this as 1 minus T times taxable income. And you'll see, you've seen it before, but you didn't realize, I think, at the time how important it was. Maybe you did, but this is a very common thing that you'll see in this course, this 1 minus T factor. What it does is it converts an amount from a pre-tax to an after-tax. Think of, in the formula for average cost of capital, you got a bunch of stuff about, equity and preferreds, and then you have the weight of debt times the cost of debt times 1 minus the tax rate. Because if you look at this amount, this is the pre-tax, and then if you look at that, that's the after-tax. So that's what 1 minus T does. Multiplying something by 1 minus T just takes a pre-tax amount, converts it to an after-tax amount. And you'll see that 1 minus T thing show up all over this course. So this is how I go from taxable income to net income. But what if I knew net income, but I want to know what is the taxable income? So when you divide something by 1 minus T, you bring it back to a pre-tax amount. An example of that we're going to see in this course is where we come up about, we're figuring out a break-even leasing payment, but we're figuring in the amount after tax, but we want to know what is the pre-tax amount, like how much are we paying on our lease. So you'll see, multiplying stuff by 1 minus T or dividing stuff by 1 minus T is going to show up over and over again in this course. So in this case, the net income is $46,750, and the tax rate is 15%, and so that is $55,000. So now I know what my taxable income is, so my pre-tax amount, and I can just do the difference between the two, and that gives me the taxes. So that's what I mean by bottom-up OCF. Instead of starting at the top and just progressing through the income statement and getting all the things we need, we're just given the bottom part, or the bottom line, and then we just run the income statement backwards to get the numbers that we need. And so the The interest expense is 10,000, and so that means that the EBIT was 65,000. And so now I have all the numbers that I need to plug into my operating cash flow formula. I know the EBIT, I know the taxes, and depreciation is just given in the question. So that's what I would call an intermediate level type of question. Here's another one, net capital spending. That one's really simple. If ever I erase too fast, I'm sorry, but you can just go to the video replay and pause it and look at it for as long as you want. And plus, it's on that piece of paper anyway. So this is another piece of notation you'll see me use a lot in this course. Delta, capital delta in Greek means the change. So the difference in fixed assets are, you bought 212,000 and you got 133,500 from selling your old stuff. Depreciation is irrelevant. Doesn't change your cash flow at all. Again, I saw a business once. It was a gym. Like the guy owned a chain of gyms around town, and he had almost $1 million worth of equipment. And if you looked at his income statement, was showing no profit because there was so much depreciation, but he was making over 130,000 a year. So depreciation, even though it reduces your taxable income and obviously then your net income, it doesn't actually change the cash flow of your company. The cash flow happens when you buy something. After that, depreciation is just what you call a non-cash expense. Okay, so let's look at, before I get to this, what I'm building up to is what's called the cash flow identity. Remember that in the balance sheet, you have the balance sheet identity. Right? That assets is equal to liabilities plus equity. So the way to look at it is the way the assets are called, on the left side of the balance sheet, because they're usually presented on the left. So you have your assets, and then this would be, a company with a little bit of debt and lots of equity, or this would be, say, a company with lots of debt and not a lot of equity. But no matter what, the left side is always equal to the right side. This is the balance sheet identity. What I'm building up to now is what's called the cash flow identity. There's a similar concept on the cash flow statement. It's a little bit more complicated, but let's look at the different parts of it. So first one, cash flow to creditors. This is the cash that's going to and from people that own debt in your company. So bonds or Could also be, say, bank loans. So what is the cash flow that goes to a bondholder? Interest payments, and the other part is what's called net new borrowing. So say I pay back 10,000 of bonds in a year, but I issue 30,000 of new bonds. What happens in this case is 10,000 of I paid back my old bondholder, so 10,000 cash went out of my pocket, and I have new bondholders that gave me 30,000 cash. So in that case, the net new borrowing would be 20,000. And also, then you have the interest. So those are the two parts of cash flow to creditors. Very similar thing with shares. The current income cash flow to shareholders is called dividends. In bonds, it's called interest. And then you have net new equity, which is the shares repurchase. So if I buy back, say, 100,000 of shares from my shareholders, but I, at the same time, issue 50,000 of new shares to new shareholders, then what happened was I had 50,000 go out of my pocket. So this is an example of where net new equity would be negative, right? You're reducing, if you reduce the amount of common shares you have, then that's going to be cash going out of your pocket. So the cash flow at entity has two sides. Well, it's really, I usually draw it as top and bottom. You have cash flow from assets, and it has cash flow that's going to creditors, and cash flow that's going to shareholders. Now, out of this one, you have interest payments, and you have changes in long-term debt. Same thing or similar with cash flow to shareholders, you have dividend payments, and the other component is the change in common stock. All right, so when, for example, when there's cash, if you ignore say dividends are zero in a period, if there's cash flow that's going to shares, means that you're reducing the amount of shares, and vice versa. If there's cash that's coming in from new shareholders, that means that the amount of common stock that you have on your balance sheet is going up. So that's that cash flow. So that's the how the cash goes back to the providers of capital of your company. You could think of it as the external part. The internal part is you have operating cash flow, which is really where pretty much everything's happening. Then you have net capital spending. Actually, let me just in the textbook, the formula is always written that way. I'm just going to draw it in a slightly different way to show you another concept here. You have changes in net working capital, and you have net capital spending. So this part at the top is what's called financing activities. This part is operating activities. And this is investing activities. And what this says, just like when you look at the balance sheet of a company, and the sum of the assets has to be equal to the sum of liabilities and equity, and that's always true. The cash that's being generated or consumed from inside the company has to be equal to the cash that comes in from or leaves to go the outside. There is no, some other way that the cash is going. So the sum of cash flow to creditors and cash flow to shareholders is always equal to the sum of the operating cash flow, the changes in the working capital, and the net capital spending. So if you look at different types of companies, right? If you have a growing company, what's happening with the different cash flows here? Well, maybe you're raising new capital and so on. But if you're a profitable growing company, you'll be generating positive operating cash flow, and you'll maybe use some of that money to buy new equipment or to grow your business. So say, for example, you're running a retail store. What you can do is, out of the money that you make from running the store, obviously you got to pay back your creditors and your shareholders. But then after that, if you say you were increasing the inventory, if you're buying, not just replacing inventory, but buying more inventory, maybe you move to a higher square footage retail store, or you find a way to pack it more into what you have. Remember that inventory is a current asset. So if I'm increasing the inventory in the company, there's cash going there, and the net working capital is going up, right? If I have, say, $1 million worth of inventory in the store, and I owe, say, on short-term line of credit $100,000, then my net working capital is $900,000. If I need to increase my inventory, not just replace to maintain the same inventory as before, but have more inventory, then that's going to tie up cash. That's why growing retail businesses is extremely difficult, because as you open new stores, it just your company's doing really well. You got great sales, great margins, the sales are growing, everything's great. But every time you open a new location, it just ties up, it just sucks up cash at every place that you open. That's why it's pretty tough to, retail's not the worst, actually music's the worst, then restaurants. But this is what's happening with a retail business. If you're losing money, so if there's cash that's going away, you gotta raise it from somewhere. So either you issue new shares or you get a new loan, but I guarantee you banks are not in the business of financing losses. So this is the cash flow identity. Let's do an example. All right, 7:14, so close enough. Let's get started. So before the break, I was telling you about the cash flow identity. So now what I'm going to do is an example about it. So first, let's do the operating cash flow. So the EBIT, all that stuff's now given to you. So second is the net capital spending. So that's the net fixed assets shorter way running, the change in net fixed assets and we add back the depreciation because it's included in net fixed assets, but we only care about cash flows. So the change in net fixed assets, it was 1704 at the end of the year. 1556 at the beginning, and the depreciation was 180. So you add that back. So what this means is, what's that company called? Bubblegum spent $328 more on new equipment than what it received back from old equipment that it sold. Okay, next. And remember, that's the one I said that I still see students having issues with that, the change in net working capital. So what that's going to be is the net working capital in 2006 minus the net working capital in 2005. But each one of those is itself a difference. So the net working capital in 2006 is the current liabilities minus, current assets minus the current liabilities in 2006. So at the end of the period, and minus what the current the difference between current assets and current liability was at the beginning of the year or the end of the last year. So that's how you find the change in net working capital. The next one so we want to know the cash flow from assets. Like I said, if I erase too fast, just go to lemma.ca with your laptop or your cell phone, and you can just download what I'm writing on the board. So we did cash flow from assets. Next, let's calculate cash flow to creditors. So that's going to be the interest payments minus the change in long-term debt. Remember that if long-term debt is going up, that means that I sold more new bonds than I paid back old bonds, and so my amount of debt would go up. But that would be cash that's coming in. So from an accounting basic entry, you got the long-term debt is going up. And the cash, that same amount of cash is coming in. So there's $80 interest payment. And the long-term debt was $550 at the end of the year and $500 at the beginning. And so this is the cash flow. I use the the abbreviation CFC, but it's cash flow to creditors. So this is the cash flow from the point of view of the creditors. And so we paid $80 of interest, but we also increased our long-term debt by $50. And so we paid out 80 in interest, but we got 50 in net new borrowings. So the net cash flow from the point of view of the creditors, they received $30 as a group. And the last one. $109 of dividends. And here, remember that question, the common stock goes from 600 to 580. What that means is you bought back $20 worth of shares in that year, and so that's $20 that went out of your pocket. You reduce the amount of common stock on your balance sheet, but cash went out. And also dividends is also another outflow. So you got 109. $109 in dividends plus 20 in shares buyback or net shares buyback. Now remember I told you that it's called a cash flow identity because it's identical obviously. And so we calculated it this way the first time and we got 159. And if you calculate it the other way, which is cash flow to creditor plus cash flow to stockholders, 129 plus 30 equals 159. So the cash that's generated or consumed from the inside of the company has to be equal to the cash that's going out to providers of capital. There's just not, cash can't just disappear. You can't just have cash that appears out of nowhere, and you can't have cash that just, disappears. If you did have cash that disappeared, then it would be accounted for as, say, employee theft, and then that would go into your operating cash flow. But the identity, it's always equal. So that's a check. When you do a, say, a quiz or a midterm question, that's a check on your answer. That's not just in this context, but almost anything when you do math stuff. If you know that you're able to calculate a certain number two completely different ways, it's a very powerful quality check because you do it, and if the numbers are equal, you know that you did something right. And if it's not, then it's a hint on where you can go and find your mistake. So it's a nice way to check your answers, to do it one way and then do it the other, not to try to get to cash flow from assets, figure out cash flow to creditors and just take, one minus the other to get the other one, because then that wouldn't spot if you made a mistake. Okay, so that's it for cash flow. So now I'm going to start talking about taxes. And the reason why we care, this is not really an accounting course, but the reason why we care what the taxes are, it's because who cares if you have a company that's making $1 million if, say after you pay your taxes, you got $1,000 left, or maybe 100,000. So from the point of view of a finance person, what you always look at is, what is my after-tax cash flow? You'll hear that expression over and over and over again from me. Every financial analysis we're going to do in this course, we always look at what are the cash flows after we account for the taxes, because this is the actual amount that goes in and out of our pocket, either as an owner of a small business or the manager representing the shareholders of a big business. So let's talk just a little bit in general about taxes. Most of you have probably seen this before. You've probably done your tax return. It's called a T1. This is for an individual, And if you're a sole proprietorship or partnership, then there's a special, extra section that you add, but it's still the individual tax return. It's called a T1. When you're a company, that's the how you report sole proprietorship and partnership income on your individual T1 return. It's the Form T2125. That's what it looks like. If you're a corporation, you don't actually file a T1 tax return. You file what's called a T2 tax return. There's another one called a T3, and that's for trusts. But we don't. I don't think you really covered that much of that legal structure thing, and certainly not in this course, and probably not in other either. But T1's for individuals, T2's for corporations, and T3's for trusts. It looks very similar, but some differences. The main one is that when you're a corporation, when you're an individual, your fiscal year is the calendar year. But when you're a corporation, you can pick whatever end of fiscal year you want. You can pick June 30th. You can pick, most of the time people take the last day of the month, but sometimes people pick other things. Personally, I prefer companies that have the fiscal year is the same as the calendar year, but when it comes to corporations, you can pick whatever you want as your year end. So these are the forms that you would fill if you did tax returns, or at least this is how people did them before people started using these tax packages. But it's actually quite useful to go through some of these one day, especially if you're going to own your own business. Like I've owned my own businesses for, 10, 12 years now, and I've always done my own tax return. And I just use the paper return because I don't have to spend, $300 to buy the software package. It's not that complicated when you have a small business. So those are the different tax returns. Obviously, in the T2, you have, a lot more, sub-forms, but this is not a tax course. So there's two concepts that I'm going to bring up now. Average tax rate and marginal tax rate. I'm going to introduce them more as an example instead of having a theory slide first. But here's the difference. Average tax rate is the tax that you're paying over your entire income. Marginal tax rate is the tax that you're paying if you made one more dollar. So if you look at this here, and say I'm already making, say, $60,000, well, if I make one more dollar of income, I will get to keep 75 cents of it. But if I'm, say, already at, say, 120,000, then if I make one more cent of income, I'm only going to get to keep 61 cents of it. The concept of marginal tax applies when we do project analysis because this is the tax rate that you use in a cash flow analysis, because whatever the company is already making, you're looking at, do I do this project, yes or not, yes or no, and that's just in addition to what you're already doing. So you can't just take the smallest tax rate, because if this is a project that's within a bigger corporation, you got to use the tax rate on one extra dollar of income, which is called the marginal tax rate. But anyway, at the same time here, I'm introducing the concept of tax brackets. I'm sure most of you are familiar with it already, but just to be clear, the way that most, some emerging countries, I'm not sure, they might have a slightly different tax system, but in general, in what you would call developed countries or Western countries, this is the kind of setup that you have. You have tax brackets, and the higher the amount of money that you make, the higher the percentage on, not on the whole thing, but just progressively on an extra part. So from 0 to 50, this is the example there. From 0 to 50,000, you're paying 15%. And then on the amount between 50,000 and 75,000, you're paying 25% of that, and so on. On the amount between 75,000 and 100,000, you're paying 34% of that. You're not, if your income is between 75 and 100,000, you're not paying 34% on the whole thing. You just pay 15% on the first 50, then 25% on the next 25, then 34% on the amount that's above the 75. So let me show you an example. So in this case, I'll pay 15% on the first 50,000. You'll see me use that, that's an abbreviation, 50K for 50,000. The other one is M for a million. I'm sure it's pretty obvious. Then you pay 25% on the next 25,000. Then you pay 34% on the next 25,000. And then you pay 39% on the amount that's above 100,000. If you were, usually, that side's not quite clear. Usually you would have another bracket. So you would have, say, 335 and up would be something else. But just the way that the example was in the question bank, they didn't set it up that way. But that's how tax brackets are. You usually have one final bracket, what they call the top bracket. That's what the whole fiscal cliff stuff was in the US about, that just happened. It was about just changing the percentage on the top bracket of income. Or, yeah, that's all it was. So, in this case here, you're making 178,500, and so you'll pay 39% on the 78,500, not on the whole thing. So my total taxes here in this case are 52,865, and so the average rate, or the average tax, is going to be the taxes that I paid divided by what my taxable income was. So in this case, paid 52,865. My taxable income was 178,500, and so the percentage is 0.2962, which is 29.62%. And in this course, you always need to give 2 decimals after a percentage, because that's the way that finance people work. If you look at this, this is, say I had 7.5%, or sorry, say I had 1.5%. The 2 decimals after a percentage are called basis points. So that would be 1.5% or 150 basis points. And basis points is how interest rates are reported, how they're handled in financial systems, bank, computers, and that kind of stuff. So whenever you give in this course, you got to learn in finance, you always give 2 decimals after a percentage. Not 3, not 4, not 1, not 0. Exactly 2. Not less than 2, not more than 2. Always 2. And that's the official way of representing percentages. I guess it's the same way that when you talk about a money amount. You don't say something cost you $18 and 700 and 7315 4 cents. Like that doesn't make sense. So make sure you understand that. Okay, let's look at marginal tax rate. So marginal tax is not the whole tax, but it's the change in taxes. So if I'm already have a taxable income of $98,650, and I make another $13,000 on top of that, what am I going to pay extra in taxes? Well, if I'm at $98,650, what's going to happen is some of that $13,000 is going to be charged taxed at the 34% bracket, and the rest is going to be charged at the 39% bracket. What's that? That's like 1,350. So if you make an extra 13,000 and you're at 98,650, 1,350 of that 13,000 is going to be at the 34%, and the rest of it is going to be at 39%. Now, I'm pretty difficult about, percentages just because I want to, if you're going to go and get a job in finance at some point, you got to understand the concept of a basis point because that's how the whole world works, especially in the bond markets. When it comes to dollar amounts, usually, I don't care whether you round to the nearest dollar or if you put the cents or not. To me, it really doesn't matter that much. Unless it's say, you're talking about a unit price and it's like, $1.28 or something like that. You don't want to round to one because you're going to blow your whole question. But when it comes to, answering a question, the cents are not really necessary. You still get full marks if you give it to the rounded to the dollar. Okay, so that's average tax rate and marginal tax. The next tax topic is capital cost allowance. Now, this is one thing that's annoying about CRA is that they just reinvent what people are already doing, but they just call it something else. So if you just talk, for example, you can't see very well. You could see it better maybe on your laptops or something like that. But what we call net fixed assets, CRA calls it undepreciated capital costs, UCC. What accountants call depreciation, CRA calls it CCA, capital cost allowance. So it's the exact same concept, but they just have very strict rules. What's the declining balance percentage that you use, and there's the half-year rule and all that. But really, all they're doing is just replicating the depreciation setup that you've learned in accounting. They're just calling each thing a different word. It's the same idea. So CCA, capital cost allowance, is depreciation for tax purposes. It's deducted before taxes and acts as a tax shield. What does shield mean? It means that if, say I have a deduction of $1,000 for my capital cost allowance in a year, and my tax rate is 20%, then the net effect on cash flow of having that depreciation is positive because it reduces your taxable income, and therefore it creates, that's where the word shield comes from. It shields you from paying tax. So if I had a CCA deduction of $1,000 in a year, my tax rate's 20%. I'm going to pay $200 less in taxes because of that deduction. So that's why it's called a tax shield. Every assets are assigned classes. So here's some example of classes. Sorry, it's a little bit too small, but class 1 and 3 are buildings. 7 are canoes and boats. 8 is very common. It's property that you did not include in any other class, but almost all companies have stuff in that class, and it's usually furniture. All right, so when usually the simplest type of depreciation setup that you have for a company is you'll have one class for computers and then one class for furniture, and that's it. Obviously, if you take the example of my own business, I own a building in downtown Hull, and so then you got a class for buildings, and then if I put in my car in the business, then you have another class for cars, and then maybe one day I'm hoping to have something in class 9, which is aircraft. So, but there's more. That's not all the different classes. There's a lot more than that. It goes up to like 50 or 60 or maybe even more than that. But for each class, the CRA gives you what the declining balance rate that you're going to use for that class. There's only a few classes, almost all classes, I would say, all of them except, I think there's only 2 that I know of are declining balance. The 2 that I know that are not declining balance but are straight line one is leasehold improvements. So leasehold improvements, if I lease a commercial space and I spend money fixing it up, like I put tiles, I paint the walls, I maybe put some new light fixtures and so on. You don't actually enter that on your income statement as an expense in your startup year. What you do is you straight line depreciate it over the life of the lease. So say I lease a store in a mall, and that's a 5-year lease, and I spend $1,000, to paint and put some new lights in the place. Then what I would do, this is not a declining balance fixed asset. It's a straight line fixed asset that's depreciated over the term of the lease. So if I, 1,000 over 5 years, I would get 200 as CCA each year. Another one, the only other one that I know of that straight line is amortization of franchise. So the example in my case, when I bought the franchise for Sunbelt for Western Quebec, I paid $25,000, but it doesn't create a $25,000 expense in the first year. What it is it's a franchise. Usually most franchises have a term. So I have a 10-year term on my franchise agreement. And so instead of taking the full $25,000 in year 1, then since the franchise has a 10-year term, then I take $2,500 per year of the franchise agreement. Those are the only 2 classes that I'm aware of that are straight line. Every other thing you can think of, cars and plates and dishes, if you like a restaurant, computers, all that kind of stuff. They're all declining balance, and CRA tells you what's the declining balance rate that you use. So if you don't remember what the difference between declining balance depreciation is and straight line depreciation, that's something that you should review. So that's what I say. Every asset class is given a depreciation method and rate. Like I said, most of them are declining balance, and I showed you that they give you the rates for each one. There's one more twist, which is what's called the half-year rule. Here's the idea. If I buy something, say, for $10,000, and I bought it, say, in mid-December, well, I don't get to depreciate for the full year because I only say used it for like 2 weeks. Vice versa, if I bought something, say, in the second week of January, then would I use, say, like 90% of the amount? No, I would not. The system that they came up with is they said on average, some things you'll buy late in the year, some things you would have bought early in the year, but on average, it's as if you had bought in the middle of the year. So if you buy something for 10,000, you only get to take the depreciation on half of it in the first year. That's where the half year rule comes from. It's in the year that you buy something, you only get half the CCA deduction. And it's at the half because it just splits, it's the average. Some of them will be late, some of them will be very early, but on average it will be roughly in the middle. So that's where the half year rule comes from. This is what the table looks like. So you have the different classes. So typically, like I said, you would have, say, 8 and 45. So 8 for furniture and 45 for computer equipment, unless you have like buildings and canoes or whatever. Undepreciated capital costs is what you started with. So say if I just start a company, I own nothing, that in the first year, that column will be empty. Right? I buy something, cost of additions, minus proceeds of disposition. So this is what we call purchase of and proceeds of disposition is what accountants call salvage. Like I told you, CRA duplicates, mirrors every single thing that accountants do. They just change the name on it. It's ridiculous. And then you apply the half-year rule, but it's only there's a small small twist to it. You only apply the half-year rule if you have some salvage. Anyway, because the way they see it is also when you get rid of something in the middle of a year, it's as if you had sold it exactly in June. So the half-year rule also applies at the end. It applies in the first year that you got something, and the last year you got something. Then you have the base amount, which is whatever the adjusted amount after the half-year rule is. You have your declining balance rate, and then that gives you what your CCA is. And then if you take what you started with plus what you had bought minus what you deducted, you get what's left for the next year. You'll see an example in a bit. Now, the first point, if you think of Loblaws, how many cash registers do they own? Thousands. When they file their income tax return, they don't show, oh, I own this this cash register, and that other cash register, that other cash register. They're all grouped into these classes. So it's not like I own a laptop. Like say if you were like a computer company, you wouldn't have like a line for my laptop, a line for my desktop, a line for my printer. All of that would be computer equipment, and it would be on a single line. So that's what's that. Usually firms have multiple machines or multiple assets in a single class. When the asset is sold, you reduce the pool by the amount that you salvage. And when the last asset in a class is sold, I got an important point to make about that last one here. Say I buy something for 10,000, and after 5 years, I've depreciated it to 1,000. So that would be my UCC 0, and that would be, say, my UCC 5. So it's worth 1,000 right here. If I salvage, this is assuming there's nothing else left in that asset class for that corporation. if I salvage that asset and I sell it for exactly 1,000, nothing happens, right? Because this is what you would call the book value or the UCC value for tax purposes. But you have another concept called fair market value. And that's what you could buy or sell something today at. So an example, if you take that example there, would be a car, right? I buy a car for 10 grand. 5 years later, it's worth 1,000. Well, at least on my CCA schedule, it's depreciated to 1,000. So if I sell it for 1,000, nothing happens because I'm selling it. In that case, the fair market value. There's three things that can happen. If the UCC is equal to the fair market value, nothing happens. The second thing, sorry, I should write it the other way. If the fair market value is more than what I have, then it's called recapture. Say I bought my car 10,000, it's depreciated to 1,000 when I sell it, but I sell it for 3,000. So the difference of 2,000 would be what's called recapture. What they're saying is that you got the government gave you a tax break while you own that asset, but if you sell that asset for more than you've depreciated to, they will recapture that difference. So you would add 2,000 to your income for that year. The other thing that can happen and that happened a lot with computers. A little bit before your time, maybe 10, 15 years ago. No, I think they changed that maybe 5 or 7 years ago. It used to be that the declining balance on computer equipment was 30%. But in reality, I'm sure you know that the computer that you bought for $1,000 a year ago is not worth $700 today. All right, it's usually worth about 500. So what was happening is most company, they would end up with their undepreciated capital cost was nowhere near what reality was. So originally the idea of a terminal loss came from, say I have a computer that I bought for 10,000, and based on my books, based on UCC, I've depreciated to 1,000, but I'd be lucky to get $1 for it on the street. Right? The asset depreciated faster than based on my tax schedule. So in that case, there's two examples that you could look at. Either you sell it for less. Say I sell the asset for 500, then there would be a $500 terminal loss. Another example would be that the asset is worth nothing. Like I'm still carrying it at 1,000 on my CCA schedule, but there's no way I could get a single cent for it, right? It's like a 10-year-old computer. It's not even worth like the plastic on it, right? So then I would say that I got 0 for it, and then the whole 1,000 would be the terminal loss. There's one small exception, I guess it uses as D, is if the fair market value is bigger than the original cost. Could somebody give me an example of something that I would buy and I would depreciate it on my CCA schedule, but then when I went to sold it, I would get more? Cars is an example. Most of the time, this shows up with buying property, right? You got a land and building, and you end up selling it. You actually depreciate the building for income tax purposes, but in reality, when you go to sell the building, usually you get more than what you paid for. Usually. So if I say bought something for 10,000, depreciated it to 1,000, but I sold it for 12,000. Then what would happen? You would have recapture up to the original cost, and then you would have capital gains on top of that. And remember, with capital gains, you only pay half the rate. So if say the tax rate on something is 20%, then I would pay 10% of 2,000, which is the cap gain. So this is what happens when you have no assets left in a pool. Either if it's exactly the same, nothing happens. If it's more, you have a recapture. If it's less, you have a terminal loss. If it's more, you have a recapture up to the original cost of the asset, and anything on top of that becomes a capital gain that's taxed at. Recapture is taxed at regular income, and then above that is taxed at capital gains rate. So that last point there, even though it doesn't look like much, is actually quite important.
Do you get reimbursed for terminal loss?
What it is it's not a refundable tax credit, but it reduces your income tax paid. So say you made 50,000 in a year, but you have 10,000 a terminal loss, your taxable income would be 40,000. If you were recapturing 10,000, then your taxable income would be 60,000. Whatever difference between the tax schedule and the fair market value flows back into your income statement. Okay, so let's look at a simple example of doing a CCA table. So you buy $100,000 worth of photocopiers. Now the CCA rate is 20%. But what happens is you could do this is kind of a shortened way of doing it. You could do the full table. You could do that full table here where you would say undepreciated capital cost at the start of the year is 0. Cost of addition a year 100,000. No disposition. So the base amount for the CCA would be just 50,000. And then you would apply a 20% percentage. A quicker way of doing that is just to use half the CCA rate in the first year. So you just start with 100,000. So you get, 9,000 the first year? Oh no, 10,000. And if you take CCA, remember, is the same as depreciation. So if you start with something at 100,000, depreciate it 10,000, you're left with 90,000. That becomes your UCC for the beginning of the period, next period. And so now you got 20% of that is 18. And so, sorry, the question was asking for how much CCA, total CCA will be claimed in 2004 and 2005? 28,000. So this is what's called CCA. A little bit later, we're going to talk about another concept called CCA tax shield, which is the amount of money that you save in taxes from having that CCA deduction. Okay, so this is it for today. The way that I teach is, just so you know, I put a section, what I call more examples, on each of my courses, because I never quite know, am I going to run late? Am I going to run early? So what I do is I always toss in a couple more examples from what I did that day. There's no new material, but it's just more of the examples that I did in the class. So I usually take a break at this point. You're free to leave if you want. You're free to stay if you want to. Usually, most people leave, but you could go back later when you're studying, and these will be on YouTube. And also the solutions will be in the notes. So I'm going to take a 10-minute break now. And then after that, I'll do a couple more examples. Like I said, no new material. And then we'll be done for today. But as of now, this is the end of new material. I'll see you next Tuesday. Okay, so let's continue. So like I said, there's no new material here, but it's just more the same. So if you want to see, because what happened was I've been teaching these courses for a very long time. I think this is the 8th or 9th time that I'm teaching this. And every time I always get on the teaching evaluations, more examples. Can we have more examples? And I just double the number of examples. Then I get to teaching evaluation the year after that. More examples, please. Then I put more in, and more examples, please. And so I just piled in as much. I just took all the examples that I could find out of the question bank, and I either use them in the main part of the lecture where I'm introducing new stuff, but whatever examples that I can find that I don't have to use in the regular course, I just add them up. I just pile them up at the end. So people that want to, because a lot of people learn by seeing and by doing, and so they just want to see lots and lots of examples. And so that's the purpose of more examples. The other reason is that it's very hard to time exactly to finish, not go over or, not finish like 45 minutes early and, look like be out of material with say, an hour and 45 minutes into the course. So I came up with this more examples thing of, it's kind of like a slush fund of time, basically. But it serves the purpose of showing more examples to people so that they understand better. And even if you miss it, you can still get the notes for it, and also it's going to be on YouTube. Track shoes. Okay. So this one is an operating cash flow problem. But this one you got to think a little bit. You want to know the EBIT, but it's just you have the net income and the taxes. You could do that thing that I showed you before, where you you run the income statement backwards. But another thing that you can do is if you just write it this way, what is EBIT? It's the net income, right? Think of it. You have net income, taxes, taxable income, interest, and EBIT. So another way to write what you can do is write EBIT as net income plus interest plus taxes. Right, that's your EBIT. Plus depreciation minus taxes. Well, here you got plus tax, and here you have minus tax. So it's really just net income, which is 19,600, plus interest, which is 650. Right, remember, the company repaid 4,200 in loan principal. That has nothing to do with the income statement, right? That's a balance sheet transaction. The 4,200, what would be the accounting entry there? Would be debit long-term debt, credit cash, right? Or I always flip the credit and debit how the accounts do it, but you get the idea. So 650 is the interest, and 420 is the depreciation. And so the operating cash flow here was 20,000. I just wanted to show you a little metric where you just expand one of the components, and then you can cancel it out. But you'll see when we get in, it's either 10 or no, I think it's 10 or 11. This is called the bottom-up way of doing operating cash flow. Operating cash flow is net income plus interest plus depreciation. So the next example is one of those long cash flow identity type questions. And hint, hint, nudge, nudge, this makes a great written question on a midterm. Because it's one of these, nice multiple part kinds of things. Okay, so let's find the net working capital. Why do I have 70 plus? Oh yeah, okay. So the net working capital for 2006 is going to be current assets. I'll use 06. I'm getting lazy. And so what are the current assets? You have cash as a current asset. Accounts receivable is a current asset. And inventory is a current asset. Wait a second. What? I think I have a mistake in this one. $405 is the current liabilities, yeah. And 640. So what are my current assets? Cash of 75, accounts receivable of 502, and inventory of 640. And what are my current liabilities? They're just given to me as a group, 405. So my net working capital at the end of 2006 is 812. So now let's figure out the net working capital for 05. So the change in net working capital is going to be 812 minus 905. So that's A. The net capital spending, so that's A. B, net capital spending, so that's the change in net fixed assets plus the depreciation. So fixed assets end at net fixed assets 1413. They started at 1680, but we also took 210 of depreciation, so that doesn't actually see, net fixed assets includes the depreciation, but net capital spending doesn't. Net capital spending is a pure cash flow amount. So that's why you add back depreciation, because it was in, you subtract, to go from, if you buy, if you don't buy or not sell anything at all, then the net fixed asset from one year to the next is just going to be a reduction based on what the depreciation expense is. So in this case here, you got plus 210. So the net capital spending is minus 57. What that means is we salvage more than we bought new stuff. So maybe we bought, some new things for $57, but we, anyway, you get the idea. So next is the first one, that was A and B, was the net working capital together. And then C was the net capital spending. So D is what is the operating cash flow. So we do our little income statement. Sales are 785. Less COGS, cost of goods sold, 460. Less also depreciation, 210. Gives us EBIT, 115. Less interest, 35. Gives us taxable income of 80. Taxes are 35%. So the tax on that is 28. And then you could calculate your net income, but you don't really need it anyway. So that was that. That's 60, 52. So, operating cash flow is EBIT plus depreciation minus taxes. And so you need the EBIT, the depreciation, and the taxes. So next, we're at E now. Cash flow from assets is operating cash flow minus net capital spending minus changes in net working capital. So the operating cash flow is $297. Net capital spending is, and that's something you got to be very careful about. You end up with a lot of double negatives in those types of questions. The formula is, even when I give the formula sheet, and it says operating cash flow minus net capital spending minus changes in net working capital, people still put plus 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 through the whole thing, even though they have the formula right in front of them on the formula sheet. So you got to be careful. The net capital spending is minus 57. So that's minus 57. And the changes in net working capital is also negative, but it's minus a negative change. So that's minus 93. So 297 plus 57 plus 93 gives us 447. So that's the cash flow from assets. Okay, next one is, what is the net new borrowing for 2006? It's called net new borrowing in a textbook, but I just use change in long-term debt because it's easy to remember, it's easy to write. So you end with 410 of debt, and you started with 340. So the amount of debt that you have went up from 340 to 410, meaning that you received $70 in cash, right? There's a plus there. Right? When you sell a bond, you give a piece of paper that's a bond, but you receive cash back. When you pay back your bond, you give cash and you take the bond back. So the cash flow to creditors is going to be the interest payment minus the change in long-term debt. So the interest payment is 35, and debt went up by 70. So when debt goes up by 70, from the point of view of the creditor, that's money going out of their pocket. Right? This is CFC, but it's cash flow to creditors. So this is the cash flow from. Remember that with cash flow, there's always two sides to a transaction, right? What is a cash inflow to one person is a cash outflow to somebody else, and vice versa. So from the point of view of the creditor, from the point of view of the company, you receive the $70,000. But from the point of view of the bondholder, it's $70 out of their pocket. So it's an outflow to them, it's an inflow to you, and the cash flow to creditors is from the point of view of the creditor. So if you pay 35 in interest, but you raise $70 new of debt, in reality, this is 35 that went from the creditors to you. And the last one is the cash flow to shareholders. And that's the dividends minus the change in common stock. and you can do a check. Remember that cash flow, call it, a check. Cash flow from assets, cash flow to creditors plus cash flow to shareholders is minus 35 plus 42 is equal to 447. Right? The internal cash flow has to be equal to the external cash flow. There can't just be cash that's created or cash that's destroyed. All right, this is a tax example. So first, that's A is pretty obvious. What is the marginal tax rate on an income of 82,650? So if you're already at 82,000 and you make one more dollar, that extra dollar is going to be taxed in the bracket that you're currently in. So it's going to be taxed at 34%. What is the marginal tax rate on an income of 239,650? So anything, if I'm already above 100,000 and I make an extra dollar, then that will be taxed at 39%. Then the last one is, what is the total tax on an income of 289,600? So as before, you'll pay 15% on the first 50,000. You'll pay 25% on the next 25,000, which is the amount of money between 50 and 75. Then you'll pay 34% on the next 25,000, which is the part of the amount between 75 and 100. And then you'll pay 39% on what's above that. So if you have already paid the taxes on the first 100,000 and you're making 289,600, then you'll pay 39% of 189,600, not the whole thing. And so the total taxes would be 96,194. And here we are, last more example of the day. Capital cost allowance example. A firm has recently purchased class 10 equipment for 100,000 with a CCA rate of 30%. Under the half-year rule, what is the amount of depreciation that the firm can claim as a tax deductible expense in the second year? So that's important there. It's not what the CCA is in the first year, but what the CCA is in the second year. Remember the half-year rule. You could do you could either say apply 30% on half of that amount. So apply 30% on 50,000. But another thing you can do is just say apply 15% instead. All right, so that is half of that. So you get 15,000 in the first year. You don't really care. That's not what the question is asking for. But the reason why you need to know that is because you need to know what is the UCC at the end of the year, so that you can carry it forward to the next year, and then know what the CCA deduction is going to be in the second. So that's it for tonight. I will see you next Tuesday.